Alexa, auto.
So, yeah, but good.
Assalamu alaikum. We welcome you all in the corporate briefing session 2025 of National Refinery Limited. All the participants are requested to kindly mute their mic during the presentation. You may place your question in the chat option. Question and answer session will be conducted on the conclusion of the presentation. Now, before we proceed formally to the presentation, I will request Mr. Sardar Khan to kindly recite few verses from the Holy Quran.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم قل هو الله أحد الله الصمد لم يلد ولم يولد ولم يكن له كفوا أحد صدق الله العظيم.
आप शुरू करेंगे presentation.
Jazakallah.
Okay.
Now, may I request the CFO to kindly give the presentation.
Share कर
Yes.
Okay, let's start with the brief presentation on the financial results of National Refinery Limited for the year ended June 30th, 2025. Next. The company overview, as most of the audience must be knowing that NRL was established in 1963 as a public listed company. The refinery complex consists of three main refineries, two for lube section and one is like fuel refinery. Lube refinery was commissioned in 1966, then fuel refinery in 1977, and the second lube refinery was commissioned in 1985. Then the company undertook the major upgrade in 2017 when we achieved this HSD desulfurization and isomerization upgrade. Whereby the company is the only refinery that is producing a Euro 5 diesel and providing the Euro 5 compliant diesel to the industry. We have the crude oil capacity, refining capacity of 70,000 barrels per day. If we go in terms of barrels, it comes to 23.1 million barrels per annum, and it's 2.3 million metric ton per annum. Our major shareholders is Atak Group with Pakistan Oilfield holding 25% shares, Atak Refinery holding 25% shares, APL with 1% share, it comes to 51%, and then Islamic Development Bank is holding 15% shares in National Refinery. Our long-term credit rating, as maintained and done by PACRA, is AA for this year. And our accreditations include ISO certifications relating to environment and quality. So this is the update. What sets NRL apart from others? As we discussed in the previous slide, the only lube refinery in the country, the only refinery producing Euro 5 compliant HSD. Besides this, we have a petrochemicals plant which is BTX, the only BTX plant in the country in the refinery sector. Ability to capitalize on bitumen strength to cater to seasonal demand, being the pioneers in the refinery, producing bitumen. We are carrying this market value of the plant that was carried out in May 2020. It is around $420 million. And recently we conducted the land valuation, which comes to like 46 billion, and in terms of US dollar, 165 million. Sustained operations of over 6 decades, that is our forte, starting from 1963. And the major thing is like the pipeline connectivity from port in Karachi till like upcountry. So these are the some bullets like which sets apart NRL from others. Next. This is the trend comparing with the last year. So it was sort of a mixed trend, and the average for the period was $75 as compared to corresponding year it was $87. So where we see like starting from March, there was a steep decline on month-on-month basis, basically because of Trump tariff and OPEC that was announced in March and April. And then in June, there was some breather for the refinery, and that helped us like in regaining the GRM. This is over company highlights. If you see like the gross refining margin, it has increased to 12 billion in absolute terms. In the corresponding year, it was 8.4 billion. And there was around 15% or 20% increase in the manufacturing expenses, mainly because of increase in utility expenses, both sides on the consumption side as well as in the tariff. So the gross loss slightly reduced from 7.7 billion in the last year to 6.2 billion in the current year. Finance cost, it was at 10.3 billion, and in the corresponding year, it was 9.3 billion. So the loss after tax turned out to be 14.9 billion, whereas in the last year, it was 15.8 billion. This is the production mix comparing with the corresponding year. There is increase in HSD if we see the production yield, mainly because we switch our crude mix, and there was a major shift in the crude mix going towards the lighter crude, adding the lighter crude towards the crude mix of NRL. And rest there was increase in MOGAS as well, but in terms of percentage, we can't see like a major increase because there was a lower throughput in the last year. It was around 48%. In the current year, it is around 56%. So this is the production mix of National Refinery. These are quarterly production yields. Comparing with the, referring to the previous slide, if we see starting with the first quarter, the prime products, if we refer to like HSD and MOGAS. So HSD, based on previous crude mix, it was 40%. Then in the second quarter, we started to gradually shift the crude mix towards the lighter crude. And now we are in the range of 43, 44, and 45%, even targeting more with some operational efficiencies that we are targeting.
And also, if we go back one slide, just to add on to what Noman suggested, if you look at the crude mix, we have completely switched. For first quarter, we had 75% heavy crude and 25% lighter crude. And if you look at the fourth quarter, the picture is 75% lighter crude. So that's what we were targeting, that lighter crudes will give us better diesel yields, better MS, and less and less furnace oil, loss-making products, things like that. So that's what we have been focused on, and you will see the increase in the diesel yield as well from first quarter to the second quarter. From 40 to we have achieved 44%.
Yeah.
So as we showed like a crude trend, so you will see that even in terms of products, if you look at the diesel price or mainly diesel price, it was a downward trend. And as you all know, that any time we have to take inventory hit, there's a decline in the price, we have to take a huge inventory hit because of the nature of the business. There is some crude available, there is always some diesel available because we have to have a continuous operation. So if you look at this year, most of the times, most of the fortnights when the price changes, we had to face a declining price trend, and that led to a significant inventory losses, and we had to take huge hits, and that's one of the primary reasons for having such a huge loss during the year as well. Okay. This is our sales mix, more or less same amount of diesel we have sold. We have introduced MS95 front product during the year, so MS percentage is also same. It's more or less the same sales mix if you look at between the 2 years. But however, in terms of metric tons, the picture is different because the base number has changed. We were operating at, as Numan mentioned earlier, at 48%. Now we are operating at 56% during the year. So if you go to the next slide, you will see. So,
Previous.
yeah. So that's fine.
Next slide.
So in this slide, you will see that we have been working quarter by quarter to increase our sale volume. So we were at like a little bit on the lower side at 340 first quarter. We reached about 390 second quarter, 442, and the same number in third and fourth quarter. So we have been continuously working with the market with lots of other things to increase our sales volumes. Okay.
Next.
This is a story of a snapshot of our throughput. So again, same story. We were operating at a little bit lower side of the throughput, about 43, 53%, 47% numbers you will see. But as we move towards the end of the year, we are targeting now like 65, 70%. 64 was June, but beyond June, really, we have been targeting now 70 to 80% throughput. Because we know that for a complex refinery as ours and a huge complex like ours, we need higher throughput to divide our fixed costs. Next slide. So in this slide, you will see what I was talking about in terms of diesel volume. It's almost like a shift of about 80, 90,000 metric tons. So we were at 610,000 metric tons during the previous year, and now we have increased it to right around 700,000 metric tons. MS, there is a slight change in numbers, and then one of the biggest change and biggest gain for us, as if you will, is the LBOs. We were at about 100,000 metric tons. The year we closed about 125,000 metric tons. Rest of the things are more or less the same. All right. So this is just some of the challenges we faced during the years, as we shared through the graphs that global refining margins, there was significant volatility between the product pricing and between the crude pricing. And if there is a declining price trend, it leads to a significant loss on a month-on-month basis. And whenever there is a price decline trend, OMCs also kind of sort of restrict their upliftment. So that's like a double whammy for us, because then you can't operate at a higher throughput. Overall, we also faced significant challenges during at least this first, second, and third quarter of the year was related to smuggling, and that impacted our sales. We are also, just like all other industries, we are seeing an increase in our operating expense. And also what happened during the earlier part of the year was there was significant fluctuation in dollars. Towards the end of the year, it was fairly stable, but earlier quarters, we had to take a significant hit in terms of dollar exchange parity. And it was like right around 2 billion rupees we lost because of the exchange loss. And even if you compare it last year before last, you will see that it was a small number of 150 million rupees. But overall, so we are really a little bit happy to share, if you will, that our whole objective is to minimize our losses and turn towards profitability during the year. And that's the reason we changed that crude mix as well from heavier to lighter. So first quarter, we had to take a significant hit. We lost about 6.7 billion rupees. Second quarter, we reduced our losses to 1.6 billion, 714 million. And at an operating level, happy to share that fourth quarter, we are really profitable at an operating level. And if you go to the next slide, and this is when you take into account all the financing expenses and everything at a P&L level, you again see the same story that we had a significant loss first quarter. We reduced it in the second quarter to 4.5 billion. We reduced it again to 2.7 billion. And fourth quarter kind of almost break even. We had a little bit lost, but we are kind of sort of breaking even. Another important thing and message in this slide is that also we have been trying to align ourselves with the industry. So let's say if the industry is facing a profit kind of situation or loss kind of situation, we want to be aligned with the industry. initially we felt a little bit in the early quarter, perhaps a little bit off from the industry, but we have made lots of changes in our overall system to be more and more aligned with the industry. And you will see this in our results in the third, fourth quarter, if you will. And also you will see this thing same moving forward as well in the years to come. Okay. These are just some business risks that we have to deal with. You guys are already aware that there is a volatility in crude oil prices and product prices and margins. And whenever this happens, this just the nature of the beast that we have to take a significant hit because you have locked your crude 2 months before the processing time. You have locked your volumes and you can't get out of it. And neither in a continuous industry you can slow down and stop things like that. So you have to take the volatility as part of this business, and you have to deal with that. Second is what has happened. There was an impact on the sales pattern as well, because we were trying to have more and more sales, but for a smuggled product we had to deal with, and that was impacting our sales. We've had lots of engagement with the government and with OGRA, and they've really helped and worked with us, the ministry. And now we see that there is an improvement in the overall smuggling situation. Another issue we face is, go back please. Another issue we face is the rising cost of utilities, and not only rising costs, it's the availability of utility as well. Sometimes you're not able to get reliable power from KE. Sometimes you're not able to get water from KWSB, so it impacts operations on a day-to-day basis, but we try to manage it as much as we can. Regulatory regimes, you guys are all aware that we face an issue related to the sales tax issue, which we are working with the government. That's kind of sort of sorted out, but it's there. There is an impact of customs duty, which we have to deal with. There is an impact of forex loss, which is not priced in our pricing. And we work with the government that they need to do this thing. And then
Petroleum levy on FO.
Yes, and then towards the end of the year, from 1st of July, what has happened that we are seeing that PL has been imposed on furnace oil. This has really closed all sales avenues of furnace oil in the country, and we are having to export 100% volumes now. So these are just some of the uncertainties, business risk factors, and difficulties and challenges we face and we work with. However, next slide, moving forward, but that's the nature of the beast. So we have to deal with all those challenges, if you will. But moving forward, what we are doing is that we are really focused on HSC, which is very critical for our industry. At the same time, we are also focused on having reliable operations. So we are working on really very diligently on having higher plant reliability. Our objective overall is to have higher throughput. Higher throughput would lead to higher production of diesel and higher sales of diesel. It's a positive margin product for us. At the same time, LBOs are a positive margin product for it's a deregulated product. So what we are also trying to do is to maximize the positive margin products. I already mentioned what we have done is that we have optimized our crude mix, and we have moved from heavier crudes to lighter crudes to produce more and more diesel and reduce furnace oil related losses. We have increased our production of MS by at least 25%. We were producing about 18,000 metric tons. Now we are producing 25,000 metric tons roundabout. So that's also helping a little bit. We have also introduced 95 RON product. Also, we have created a new ventures department, and what we are doing is that we have numerous other products like wax, and perhaps we have created a few more grades of LBOs. So we are working towards exporting these, and we have received very good orders for wax and LBO exports as well, which we are working on currently. At the same time, we are the only refinery which has a BTX plant in the country. We were not using this is benzene, toluene, and xylene. So we were not using it initially, but now we are, and we haven't used it in a few decades, if you will. But we know there is a huge demand for toluene and xylene in the country. And currently we are working on the revamp of this plant because we haven't used it in a long time. It will take a little bit time to fix it. but coming, say, fourth quarter or first quarter of next fiscal year, we will have this plant up and running. So this will add to our product slate. But overall, if you look at all other refineries, they have 6 products. We have overall 26 products. So we know that the refinery offers of a huge upside and huge potential for moving towards profitability compared to other refineries in the country. That's all we had. Also, what we are doing is that just like other refineries, we are working on our upgrade project. So we are working with Wood team out of UK. We are looking at hydrocrackers, bottom of the barrel upgrades. We're just looking at options. So we are also looking at if we, within this bottom of the barrel upgrade hydrocracker, we can upgrade our loops. We are looking at the CCR plant, and we are really engaged with the government on this brownfield refining policy because we know it's very critical for it to be sorted out and signed so that we can move towards the project with confidence. Our major objectives during this the next fiscal year is that we have a turnaround plan for Root Refinery in November-December timeframe. We are working on for our platforming unit. We are working to change the catalyst, and we are working to optimize the operations. We are also trying to optimize our motor spirit. There's some quality which we feel we can improve further, so we will try to do that thing. And BTX, I already mentioned, we are working on, and it will be online Q4 or Q1 next fiscal year. Yes. Yeah. That's all we had, and we open up the floor for questions.
Saad Ali Saad.
Sure.
Ji, Assalamu alaikum. Can you hear me?
Yes, we can. Go ahead.
Yeah. First of all, I would like to thank the management for a very detailed presentation. Very good numbers. I mean, someone who's covering refineries, I think the more the numbers, the better. So thank you for that. I just want to ask about the lighter crudes. How much of which light crudes were used, and what is the maximum extent of light crude that your plant can use? I mean, can it go to 100% light crude, or there's a certain level where you would stop using light crudes?
Yeah. All right, Saad, what happened? So first, answering about the type of light crude. So we have tried Arab Extra Light. We have also tried Das during the year. We have also tried Lulu during the year. So those are the regional light crudes that we have worked with. And the second part of your question is how far can we go? So what happens? We can, at an expense of capacity, we can go even 100% light crudes. That's not a problem. But our economic evaluation tells us that we want to keep a combination of 80-20. Reason being that 20% will be heavier crude because we need a certain portion of heavier crudes for our loop plants. There are a specific kind of loops which can only be made using a heavier crude, and hence we need a certain portion of heavier crudes. So to answer your question, our combination or the economic point for us is really a split of 80-20, 80% light crude, 20% heavier crude. Having said that, if we see an opportunity where there is an opportunity to produce more and more LBOs of a specific kind and export it or get better pricing, we can increase the heavier crude as well a little bit.
Understood. Thank you. I mean, some of your competitors are importing US crude. Is that on the table for you as well? Would you be exploring that option? Importing American crude oil, or the freight differences would not be very viable. How do you see that?
Yeah, no, we will definitely evaluate. We are currently evaluating. We will evaluate all regional crudes, and I know people are importing from Nigeria. Some Nigerian crudes refineries have tried recently, and people have also tried the WTI crude. We will also evaluate. And it's really not a matter of freight as an element, you're right, but it all depends on the pricing of the crude and the GRM, ultimate GRM you can get, even though it might be an expensive crude. But if the GRM is good and if we can get more juice out of it, then you can try that crude. So we will also evaluate, like other refineries, we will also evaluate the crudes. Evaluation for us is a little bit more challenging because all refineries in the countries, they run it through the CDU and they get the results. Okay, what is the performance in petrol, diesel, and this and that. For us, we have to take it 2 steps further because we have to run it through VDUs and we have to run it through the lube refinery so as to get the results. So we are a little bit more conservative and cautious, if you will, in our selection of crudes.
Right. Thank you.
Okay.
Next.
Yeah, sorry about that.
Thank
Just one more question before others can ask. You said that, the GST issue has been somewhat sorted with, with the government. Can you please elaborate on that? Because, that is something that the IMF has not really been in favor of. How do you see that situation, resolving? Are you looking at greater IFEM in the future, or any other workaround? Thank you.
So we saw that currently the government has, or OGRA or the ministry, they've through the pricing mechanism, they've allowed a recovery for last year's GST outstanding. So if the governments can resolve this thing through IMF or whatever mechanisms and remove that anomaly, that will be good. If not, then perhaps they will continue with the same recovery model. So that's what I mean, that they're somewhat resolved, that we have seen recovery for the last year. We are seeing this thing. And perhaps if the government decides to continue the same mechanism, so we can say that, okay, we have somewhat resolution on this issue, if you like.
Thank you, sir. Thank you again.
All right.
Abdul Muiz Saab.
Gigi.
So this is Abdul Moise from Maple Leaf Capital. So I would like to continue what Saad asked that regarding IFEM reimbursement, that the amount that is mentioned in your financial statement is 3.7 billion rupees. I just want to ask that, is it the final amount that you will receive, and how will you record it? Will it go into other income, and what the tax would be on that, or are you going to record it with the relevant heads?
Muiz, as it was decided from the government side that it will be staggered, the recovery will be staggered in the next year. So we have already accounted for this thing, and this is the final amount of 3.7 billion, out of which we have received like around 600 million post the first quarter. So the recovery has been started, and it was already accounted for as it was announced by the government prior to closure of the financial year.
All right, so thank you so much. And my second question is, as you mentioned that you are trying to export wax from this year onward. So I want to ask that what is the expected revenue from this venture?
What's his name? So yeah, we are really not trying. We have already started. So we floated the product to the international market, and so we have learned there is huge demand, and we've already received orders from numerous countries in Europe, Middle East, and South Africa, and we've exported to them as well. And the margin is it's overall we just starting the business, so we have about 4,000 metric tons of wax which we can export, and then we believe that it can be like a billion or 2 billion rupee venture, a business line that we can create out of this. But we are just starting up work on this thing, so we are not 100% exports. Our goal is to export 100% if we can. We are at 25% export. The wax as a furnace oil in our furnaces, if we can export it, break even with crude or a little bit higher than crude, then definitely that would be helpful. And we believe this can be a billion, 2 billion rupees stream for us.
All right, so thank you so much. And sir, my second last question is, as you said that you are basically targeting throughput of 70%, of 70-80%. So I would like to ask that the production slate, can we expect it to be the same as it was in the last financial year, or will there be a change?
There will be a change, Moise, because so as we mentioned, and if you look at the last quarter of that year, we were producing about 43% diesel. So we are targeting to increase diesel, and that's what we will do. 44% diesel will be there. 80% is we are targeting, but let's say if there is an opportunity to increase it further, our ultimate goal really is to be at 100% throughput. So that's really the target, but the immediate near future target is 70 to 80%. We are almost there, and there will be a slight tweak to the production slate. You will see there will be more diesel is what we want out of it. More MS, we are constrained, all refineries are constrained, so MS will be more or less the same percentage, and perhaps little bit increase in the LBOs as well. So it will be a slightly different product slate.
Oh, all right. So my last question is basically regarding crude oil. That how much does it cost for you to in-house the crude oil from maybe Arab or any crude oil that you procure? How much does this cost for you to in-house that?
How much does it cost to in-house that?
The freight cost.
The freight cost.
The freight cost, Anna.
The freight cost. Okay. The freight cost is about $1.52 barrel. Correct. Almost $2 a barrel is the standardized price through PNSC.
From Farhan Mahmood Saab.
Yes,
Farhan Mahmood Saab.
no.
Looking for the lube side in your financial accounts, and looking at that, I think the standard has gone down. Previously, you used to mention lube profits in a segment reporting, how much you sell lube. There is no such information in this account. Can you tell me what is the logic behind it?
Farhan, in fact, after brownfield refining policy as the government has rolled out, so we are not regulatory bound basically to report the two segments. And considering the switch towards the lighter crudes and the change in the crude mix and overall situation, we have also started to look into the whole business as a one unit. So both occurring at the same time. So we have following the international accounting standards, and in view of the brownfield refining policy, we have adopted this approach, and we have now started to report like business as a one unit.
So that will be difficult for the analyst, community, because if you see the lube, we used to, calculate lube margins and the lube earnings. So that will be, difficult for us. You mentioned profitability till 9 months. Can you tell how much it would be like for the year? And it was around, I think, 500 million 9 months.
9 months for what? For loops, you're saying?
Yeah,
or
for lube.
Currently, I think because legally and statutory from a statutory point of view, as we have been following this unified approach, so it will be difficult to comment on this because there are certain other challenges as regard to the transfer pricing from one segment to the other, considering the imposition of the petroleum levy post year, and because the transfer pricing is also a challenge for that. So it's better we do not comment on it.
But Farhan, if you are really interested for the analysis part of it, so first I little bit disagree that the standard has gone down. We just adopted a different approach in the standard over there, number one. Number two, we have given the sales volumes for loops. So you have that in the presentation, and perhaps it's in the report as well, the sales volume for
revenue. Yes,
but
revenue,
so revenue and volume both. Volume is given
in
for
the
segment, and our prices
and the
are
revenue.
linked with national prices for loops as well. So any analysts doing some number crunching, they can easily determine out of this whole pipe, out of this whole mix, what is the loop contribution and what's there, because the volumes are there and the prices are there. Prices are published on a monthly basis. Prices are based on international prices. So it's really no rocket science to come up with an answer that, okay, what this thing is really doing to the refinery, the loops. Yes, you're right. We have merged the accounting streams, if you will, but determining that thing is no big deal.
Fair enough. Okay, your refinery, run on 56% utilization, I guess. So what you guys expecting in fiscal year 26, considering the FO levy? So what is the expectation?
As I mentioned, our target is really 70-80% for the year. So, and you will see this thing, inshallah, in our results that moving forward this year, we will be above 70%. Because we, as you all know, that we are a huge complex, we are a huge refinery, numerous plants, and it really 70-80% is the number where we should be targeting. And that's the number which really divides our fixed costs across barrels. So that's what we are targeting. And wherever there is an opportunity, we will go even beyond 80% as well.
Okay. And you mentioned that in your presentation that there will be a turnaround likely in second quarter of fiscal year 26. So it will
Correct.
for a month whole in November and December, or can you tell how long it will take?
Yes, it's a 30-day turnaround starting towards end of November, going till end of December. But it's not a complete refinery turnaround. It's just for we have multiple refineries within the same complex. We have so what we are doing is that we have two lube refineries. One is a larger, let's say 75% capacity lube refinery. The other refinery is 25% lube refinery. So we are shutting down the 25% capacity lube refinery for a month. So our lube production, 75% will be there. Diesel production, petrol person, everything will be there. A small reduction in volumes for a month only for the lube segment. And also we have been planning it for the past 3 to 6 months. So we have enough inventory of lubes so that the market will not even feel it. So there will be same volume supplied and available for the market.
And you also mentioned some capex plan, including this, refinery maintenance. So looking at the borrowing of like 60 billion as at June, are you looking? Can we expect the borrowings to further increase, or it will remain same point?
Remain more or less the same because we already cater for the maintenance, it's routine maintenance. We've catered for the turnaround. So our goal is to keep the borrowing within the same limits, more or less the same number. Correct?
Okay, thank you. Thank you.
Okay.
Akil sir, last question.
Okay.
Assalamualaikum. Assalamualaikum. Sir, Akil from NBP Fund. Sir, sir, I want to ask that what was the GRM of fuel and lube segment in FY25, and if you tell in also what the first quarter of FY26.
Yeah, Akil, that's what our CFO, Mr. Noman, explained. So we have adopted a different accounting standard, if you will. And within this accounting standard, we are presenting the report in the business unit as a whole. So internally, we know those numbers, the GRM, but we really haven't published, so it won't be prudent to share that number with you over the spot. Having said that, as I was explaining to earlier, in response to an earlier question as well, that the loop numbers are available in terms of sales, what we have sold, and the pricing is also available. So you guys can easily calculate the revenue, easily calculate the GRM as well, because crude price is also given. So if you're doing an analysis, it shouldn't be a problem.
But company-wide हम बता सकते हैं.
Yeah, company-wide. And
Okay,
just to add on to it, yes, go ahead.
Akil, company-wide आप अगर note करें, जी, तो it was like $3.68 for the financial year 25, and in the corresponding year it was $2.93.
Okay, sir. So my second question is regarding about the newspaper that recently in the newspaper it was stated that in the month of September FO production of national refining declined by 99%. So is it right?
No, that's not. I wish it was true because that would really help us with the GRM, but it's not correct. What they meant, maybe it was perhaps they meant sales volume, because what happened, production is more or less the same for furnace oil. Let's say if you don't export a cargo during September and you exported on 1st of October. So perhaps that's what they have taken. They're saying that, okay, there was no export in September, and that's the reason. That's correct to the extent that, okay, yes, there was perhaps zero export, but that doesn't mean that zero production. Production is, the number is the same.
Okay. As you said, that borrowing is also on the higher side. So any chance of right shares in the future?
It's the option is always there, but not currently like under consideration. As if you see like going forward from, so the option is always there for the board, for the shareholders, but not currently in sort of in any shape.
My last question is regarding your lube segment volume. So, which product or which category of just like SN400 have or any other product have highest volume?
400. 400 has the highest volume always. That's the staple grade.
How much? How much?
You can say about 50% must be 400.
And what is the conversion cost?
Conversion cost for the lube itself or overall?
Both.
We compare
to
like
tell
if we
both.
consider the
Better to tell
financial
both.
year 25, it comes around to $6 per barrel without considering the financing cost. That itself is around $2.7 to $3 per barrel.
So it varies from month to month. You can say it varies from different factors, but it ranges from $6 to $9
Okay, but
or $6 to $8.
but एक और briefing हम attend कर रहे हैं saying that conversion cost of their refinery was around $3 per barrel. So there is a huge difference between you and this refinery.
$3 a barrel. That's correct. So you must be talking about a hydroskimming refinery. For a basic refinery, hydroskimming refinery, the cost is right around $3 to $4 a barrel. And if you separate the lube segment out of it, and if you just look at our refinery as a standalone crude units only, so the cost will be more or less the same. But as you add complexity to the refinery, which we already are a complex refinery, so the conversion cost keeps going up.
Okay. And how much FO is used in your lube segment in terms of percentage?
All of it, 100%. Because what we do is that we produce this furnace oil or reduced crude, and then we take it to the lube segment and extract the lubes out of it, and then there is a remaining volume which we sell as furnace oil.
And that is the reason why the cost of conversion is high. The furnace oil, which is burned for its calorific value, is converted into base oils.
Okay.
Abdul Basit raised hand.
Okay, sure.
Assalamu alaikum.
Abdul Basit Saab.
Ji, assalamu alaikum. Am I audible? Ji, I have a few questions. Firstly, you mentioned that now that you have taken a unified approach, and you mentioned the overall GRM for the company at 2.93 for FY24 and 3.68 for FY25. Would it be possible for you to maybe mention the same unified GRM or overall GRM for the first quarter of FY26?
It is around $12 per barrel in the first quarter, and in the corresponding quarter, it was negative $2.36.
Negative 2.6. That was for FY25.
Yes.
Yeah.
And you mentioned, like you explained in detail as well, that the company obviously faces inventory gains and losses as well. So would it be possible for you to share quantum of inventory loss that you had in FY25, and similarly in this first quarter of FY26, I'm assuming you had an inventory gain. So could you share the quantum of that?
If we just sum up like the month-end inventory losses as the NRV that we booked, so cumulatively it was more than 18 billion.
18
in
billion
the
for
FY25.
18 billion for FY25.
Yeah, month-on-month inventory sum up, NRV adjustments.
And in these previous 2 quarters, we have seen a positive gross margin after, I think, after almost a period of 2 years. So is it true that there has been an inventory gain in these previous 2 quarters, the first quarter of FY26 and the fourth quarter of FY25?
It's a combination of Basit, lots of things. One is inventory gain is contributing, but as you mentioned, we are also changing our production slate, product slate. So
Yeah.
as more and more diesel is produced, you will see more and more positive contribution to the GRM. As we sold about 30% more LBOs compared to the last year. So we were about 100,000 metric tons, then we were at right around 130,000 metric tons. So more and more LBOs produced and sold will also contribute to the GRM. So it's a combination of lots of factors. On top of it, also, as you increase the throughput, the production cost or the processing cost will go down per barrel. So we also see that movement as well. So it's a combination of lots of factors, not only just in gain or
Yes.
loss.
Right. Thank you for the explanation. So like you mentioned, 8 billion amount for FY25. Would it be possible for you to share the amount of inventory gain in this quarter, first quarter of FY26, and the inventory gain amount in the previous quarter, that was fourth quarter of FY25?
We wanted this thing to be focused on this year only. So,
Okay.
but
So could you
board is
share the
happy to
fourth
have-
quarter amount? The fourth quarter amount inventory gain, fourth quarter FY25?
See, we can't quantify the inventory gains as it is part of the total operating
Okay.
results that we are reporting. As we are mentioning, like it is just the month-end inventory that we account for the NRV for it in the declining prices.
Okay. Okay. So you mentioned on one of the slides on the crude mixes. The presentation that you've uploaded on the PSX website, it does not have that panel, or maybe I'm missing it.
Yeah.
Could you maybe look into it? That bottom panel that you showed just now.
Okay. So maybe it got been uploaded. We can upload it, re-upload it
Yeah,
with
the
the
crude
panel thing.
mixes.
We can do that. No problem. If it's missing that, thanks for
And
highlighting. We can do that. No problem.
just for the purpose of understanding, so in terms of moving from, you showed this movement from, let's say, a 75-25 heavy to light ratio to a 25-75 heavy to light ratio. Keeping other factors constant, keeping the overall crude oil prices at the constant levels, what kind of GRM improvement comes from this change in the crude mix? Could you maybe share any such assessment that the management would have done purely from this change in the crude oil mix?
Yeah. So it's really very easy to determine, Abdul Basit. If you go back to the same slide, you will see there is a movement in the diesel. The real game is all the diesel production with it. So if you look at the diesel production, our historic diesel production is 38-39% diesel. Now we're producing about 45% diesel. So the 6% diesel change and some process optimization as well. So 2, 3, 4% is coming out of, you can say, the crude mix change, and then 1 or 2% is coming out of the process changes that we have made. So that 4% translates into, this is the delta between the price of furnace oil. That furnace oil gets converted into diesel. So now you know the pricing of both furnace oil and diesel, and you can calculate that thing. I know for every 1,000 metric tons, for every 1%, if you will, it's right around 150 million rupees. So we are talking about 400 to 600 million rupees for 4% with the diesel, with the crude mix change. And if on top of it, if you superimpose the benefits coming out of process change, the overall is 6% improvement, if you will, 5 to 6%, and that translates into 500 to 600 million rupees.
Right. And given that you've been using different types of light crude, you showed, I think, 3 or 4 variants of the light crude. So what has been the average premium that has been there on in versus the heavy crude in terms of the crude oil price difference, the delta there?
It changes on a month-to-month basis. Historically, what was happening, the heavier crude was priced higher in terms of premium and the lighter crudes, but now the situation is reversed. Currently, the delta is 30 cents between Arab Extra Light and Arab Light. If you look at these two crudes,
Okay.
this changes. This can be 50 cents. This can be $1, and so it changes every month from Aramco.
So
So, but currently the delta is 30
Right.
cents.
And we heard in a recent briefing of another refinery that the availability of the light crude they mentioned was not very reliable. So obviously, they were looking to procure lighter crude for the same purpose as you are doing as well. But they said that, let's say, they were giving the example of the Nigerian crude, that its availability is not very as consistent. So to depend on it is difficult as a long-term sustainable kind of thing. So in terms of, for example, you mentioned on going on a 70-30 or 80-20 mix in terms of greater reliance on the lighter crude. Is there any such issue with the availability factor or the reliability of availability in terms of consistency?
Yeah, no, there is what they meant with perhaps they were talking about the Nigerian crudes. So, but if you look at the regional crudes, majority of the crudes, majority of the refineries in Pakistan are using our lighter crudes. So, for the regional crudes coming out of Aramco and ADNOC, there is absolutely no problem in terms of getting either a heavier crude or a lighter crude. What they meant was that if you deviate from these regional crudes and go to a Nigerian, let's say Bonny Light, that's where a little bit supply chain challenges. But if somebody plans it so you can even overcome that challenge, that's not a big problem. But yeah, it can lead to some delays, things like that. Otherwise, we are currently focused on recruits, and all of the refineries are also 80-90% is all regional crude. So there is no problem in terms of getting lighter crudes from ADNOC or Aramco.
Right. And just finally, touching upon two things. One, now that the reimbursement mechanism has been activated for the sales tax thing. So how much has NRL already received and how much is left for this year, which would be pertaining to the previous year, I believe. And one more thing, I believe you would have already briefed about this in the past as well, but if you could maybe tell us the latest position of, like, in terms of the assessment of the addition based on current cost and everything, the estimated capex and the financing mix that has been planned for that.
So first is Noman, I think already our CFO highlighted that. So the total receivable is 3.7 billion. So out of that, in this right after Q1 in October, perhaps as we have received about 600 700 billion. So 3 billion is outstanding, which we expect to receive during the year. It will be in a staggered payment. So that's one thing. And coming back to the larger upgrade projects, so we are currently evaluating different streams with our consultant. And if you look at the range, so because given our complexity and given the variations that we have within the configurations which we can have because of the loops, if we are focused on loops, it will be different cost. If we are focused on furnace oil conversion, petrol and diesel, it will be different cost. Just to give you a range, it can range from like 700, 800 million to 1.5 billion. So you can have a project for $800 million, you can have a project for $1 billion, or you can have a project for $1.5 billion as well, depending on what we ultimately select.
And the planned financing mix for this, if any particular time finalized for this?
No, it's not really. We don't have a further financing plan because we haven't finalized the configuration and the cost, but it would be fairly typical. So you have a combination of debt and equity. Debt is, people say 30-40% equity is perhaps, no, sorry, the other way around. The debt will be about 60-70% and equity will be 20-30%. So we will see the same mix when we come to it.
Right. Thank you. Thanks a lot for the detailed presentation as well as the detailed answers to all of the questions. Thanks a lot. Really appreciate it. All right.
All question completed.
Chat box.
Chat box with yourself. Okay. What is the gross and net FO production and what grade of FO is produced? So first is related to the gross and net FO production is right around 20% of our mix sheds up. So if you're operating at, let's say, 150, 200,000 metric tons a month, 20% will be 30,000 metric tons for that thing. That's one thing. In GRM, we have already answered for the year and for the quarter. Operating expense per barrel, we have already answered, varies from, does it include all costs? Yes, it includes all costs. How much is the upgrade capex? We have answered. Loss per ton of furnace oil, local versus export, it's significant loss because if we are able to sell at, let's say, 150,000 metric tons local, we have to export at 110,000 and 20,000 metric tons. So there is a loss of 30 to 50,000 per metric ton. Exchange loss recovery, if we go down for
FY25, it was around 50%.
1.9 recovery.
No, it was absolute loss, exchange loss, and in terms of financing cost.
Input tax adjustment.
To discuss input tax.
So we have already explained that the government has given a mechanism through IFEM, and we are getting the reimbursement of sales tax.
Clear.
Okay. All right. Thank you very much. Very insightful questions. Abdul Muiz has a raised hand, so no problem. So go.
So sorry, I just want to confirm one thing. Although thank you so much for all the answers, I just want to confirm one thing, that IFEM reimbursement, as you have mentioned, we should just assume that everything has been settled now, and we shall not see anything, any extra income in the next financials. Am I right on this?
In a country like Pakistan, Abdul Muiz, I will say never assume anything. Anything can change anytime. So nobody knows what the government will do in November or December. But as of now, we had a cost of receivable of 3.7 billion sales tax. The government has said for that you can recover this thing during this year in a staggered payment, and the payment mechanism will be through the IFEM pool. The government may come up with the same mechanism for the next year, or they might resolve the issue, but we really can't say what the outcome will be. Most likely, the same mechanism might continue, but nobody can say for sure.
Alright, so बस sir last thing, मुझे थोड़ा IFEM को ना जरा ज़्यादा understand करना है कि considering मैंने ये assume किया कि all the refineries have basically adjusted this loss in their cost, and they haven't mentioned any income in the other income. For instance, जो भी loss था वो cost में adjust हो गया, and in the future it will be the same. Considering जो भी आपको receive होगा from the government, you will adjust it in the cost and not record other income.
Yeah, no, to the best of my knowledge, I don't think the other refineries or all refineries have adjusted it as a cost or a loss. It's perhaps all refineries, I like to say, I don't know for sure, but 99% sure that all refineries have done the same treatment, because the same mechanism has been given to all refineries by the government, by the ministry and OGRA and whatnot. So all refineries will be reimbursed their sales tax through the IFEM mechanism. Hence, I don't believe that all refineries would have recorded it as a loss.
All right, sir. Sir, thank you so much, sir.
Thank you.
All right. Thank you very much. Thanks for very insightful and good questions. We really appreciate everyone's participation.
Thank you.
Recording stopped.
Okay.